Do not trust here. When Trump was sitting down thinking, strategizing this tariff, trade war, was he purposely doing it beforehand to manipulate the stock market so he and his rich buddies can, do some insider trading? Let's break it down in this video. So the claim that Trump manipulated the stock market centers on three key elements from recent events, though direct evidence remains circumstantial. So we have the timing of communications and policy announcements. Trump posted, "This is a great time to buy DJT" on Truth Social at 9:37 a.m. Eastern Standard Time on April 9th, 2025, shortly after markets open. Less than 4 hours later, he announced a 90-day pause on most new tariffs, sparking a historic market rally. The Dow surged nearly 3,000 points, Nasdaq jumped 12%, and Trump Media and Technology Group, DJT shares, rose 21%. So critics argue the sequence created a reverse pump and dump effect, encouraging buys before a policy-driven surge, though no proof exists of coordinated insider trading, right? We have financial conflicts of interest, so Trump holds significant wealth in Trump Media, DJT, which directly benefited from the rally, right? Ethics experts note his refusal to divest assets or establish a blind trust raises questions about whether market-moving actions could personally benefit him. We have regulatory and investigative concerns, so call volume spikes. Unusual trading activity occurred before the tariff announcement, though specifics remain undisclosed. We have a legal ambiguity, so while securities laws prohibit fraud, Trump's general buy advice lacks explicit ties to non-public information. Experts note proving manipulation requires showing intent to deceive. Now, there are calls for probes, so Democrats, including the Representative Maxine Waters and Senator Richard Blumenthal, have urged investigations into potential insider trading among administration officials or lawmakers. The counter arguments are the White House denies wrongdoing, right? Framing Trump's post as efforts to reassure markets amid volatility. Legal scholars acknowledge presidential policy shifts are not inherently manipulative unless coupled with deceptive intent. Now, how do experts define market manipulation in the context of political actions? Let's break that down. The core definition, political market manipulation, involves speculative attacks that achieve their objective of changing prices, though trades uninformed by fundamentals, aiming to influence perceptions of candidates or policies, right? Fundamentals refer to information affecting the underlying value of a contract, right? The electoral viability and policy impact. The mechanisms, you have these speculative attacks, so large intentional trades designed to create artificial price movements. For example, a 2004 trade sports trader made concentrated investments to boost candidates' perceived strength, causing temporary price shifts. There's perception engineering, so manipulators seek to alter market participants' beliefs rather than profit directly. Historical Wall Street markets saw operatives place wash bets like phantom trades to signal candidate momentum. Timing and reversibility attacks often precede critical events like elections and typically cause short-term distortions. Prices generally revert to pre-manipulation levels within hours or days, as observed in Iowa electronic markets experiments, right? There are political nuances, so non-profit motives, unlike financial pump and dump schemes. Political manipulators may accept losses to sway public opinion. Information asymmetry, right? False narratives like exaggerated policy impact. So those can distort markets akin to layering or spoofing in financial context. Now, the legal boundaries, while open market actions like tariff announcements may appear manipulative, they escape legal scrutiny if tied to legitimate policy goals. However, coordinated misinformation or trades explicitly intended to deceive could qualify as illegal manipulation under SEC guidelines. Now, have other presidents historically influenced the stock market? Well, historically, US presidents have influenced the stock market primarily through policy shifts, economic conditions, and investor sentiment, right? Through their direct impact remains debated. So here's a breakdown of some key patterns and examples. So you have the policy-driven impacts, Ronald Reagan from 1981 to 1989. The annualized return was 10.2%. The key drivers were tax cuts, deregulation, and Federal Reserve Chair Paul Volcker's inflation taming policies spurred a bull market despite an early recession. Franklin D. Roosevelt, 1933 to 1945, overall growth 154.52%. The context was the New Deal reforms and World War II. Mobilization helped markets recover from the Great Depression. Though annualized returns were modest, 6.2% due to prolonged economic challenges. You have Bill Clinton from 1993 to 2001, market tripling, right? The Dow surged during his tenure, fueled by tech innovation, fiscal discipline, and globalization. Donald Trump from 2017 to 2021, growth like the 56% mechanisms, corporate tax cuts, and deregulation boosted equities, though trade wars with China introduced volatility. Now, economic cycles and external factors, you have George H.W. Bush, 1989 to 1993. Annualized return, you have the 11%. The contrast, despite a recession and defense spending cuts post-Cold War, markets rallied late in his term. Barack Obama in 2009 to 2017, the growth was 148.23%. Recovery was post-2008 crisis, monetary easing, and tech sector growth drove a prolonged bull market. Okay, that's what I have here today. Please take a moment right now to hit that subscribe button and the like button. If you gain value from this video and you want more videos like this, let me know right now by hitting that subscribe button and that like button. Also, let me know your opinion in the comment section below. I appreciate your viewership. See you on the next video.